Topic examines interest rate risk management practices among banks in emerging market economies, (EMEs), and explains how changes in market interest rates affect bank profitability and financial stability. Interest rate risk arises because fluctuations in market rates directly influence both the income statement and balance sheet value of banking institutions. When interest rates rise, fixed income assets such as loans and securities decline in market value, while funding costs on liabilities may increase more rapidly. These changes can reduce net interest margins, profitability, and capital strength. Effective interest rate risk management is therefore essential for maintaining liquidity, solvency, and long-term financial stability within banking systems, particularly during periods of rapid monetary policy tightening or market volatility. The topic explains that a bank's exposure to interest rate risk depends largely on the sensitivity of its assets and liabilities to changing market rates. This sensitivity is influenced by whether positions are fixed rate or floating rate and by the timing of maturities or repricing dates. For example, banks holding long-duration fixed-rate assets funded by short-term floating-rate liabilities face significant vulnerability when interest rates rise because asset values decline while funding costs increase. Duration mismatches between assets and liabilities therefore represent a major source of risk. Longer-duration assets are particularly sensitive to changes in discount rates, making careful balance sheet management critical during changing interest rate environments. A major theme in the topic is the distinction between interest rate risk management practices in emerging market economies, (EMEs), and advanced economies, (AEs). EME banks generally rely more heavily on direct balance sheet management rather than extensive derivative usage. These banks often issue shorter-term or floating-rate loans that reprice frequently, reducing duration mismatches between assets and liabilities. Because deposits in EME banking systems are also typically short-term, asset and liability durations remain relatively aligned, limiting sensitivity to interest rate movements. In contrast, banks in advanced economies rely more extensively on derivatives such as interest rate swaps to hedge duration gaps and manage exposures more actively across complex balance sheets. The topic also discusses the role of derivatives and portfolio-wide hedging strategies in managing interest rate risk. Derivatives such as interest rate swaps allow banks to alter the effective duration of assets and liabilities without significantly restructuring balance sheets. For example, a bank with excessive exposure to rising rates may enter a swap agreement that pays fixed interest and receives floating interest, thereby reducing duration sensitivity. The topic emphasizes that hedging should generally occur at the portfolio level rather than focusing narrowly on individual maturities. Comprehensive hedging strategies improve risk management efficiency by accounting for the overall balance sheet structure, correlations among exposures, and the cumulative impact of changing interest rate conditions. The topic concludes by emphasizing the growing importance of interest rate risk management for EME banks as financial systems expand and fixed-income asset holdings increase. Rising interest rates can generate substantial unrealized losses on securities portfolios and threaten bank solvency if liquidity pressures force asset sales. Consequently, banks must regularly assess asset valuations, monitor duration gaps, and evaluate potential losses under adverse scenarios. Stress testing, portfolio valuation analysis, and liquidity management therefore play essential roles in maintaining financial resilience. Ultimately, effective interest rate risk management requires combining balance sheet discipline, prudent hedging strategies, and ongoing monitoring to ensure banking stability within increasingly complex and volatile global financial environments.